Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the market site in Times Square, we have Brian Joyce. He's the Managing Director on Nasdaq's Market Intelligence Desk for a midday update. And Brian, there has been no shortage of news, no shortage of trading action, and today it seems to be all eyes have been on retail.
Retail, correct. So retail sales number came out pretty good today. They beat expectations as well. Interestingly enough, though, the XRT ETF is actually breaking down below a 5-year clearly defined support line. So that's noteworthy because you want to see what price is doing, and is it confirming the news, the headlines that appear to be positive. The price action is telling you something to be cautious about here. Could be a bit of a head fake, but we'll have to wait and see.
Yeah, well, I mean, okay, so you have one good data set, but
right.
Globally, there is a lot that traders and investors have to contend with. You have a trade deal that is not obviously going well, continuing that rate cut conversation. Europe has its own issues, Asia, and there's just a lot going on in the macro environment.
Absolutely, there's plenty of concern, plenty of risk, especially amongst policy. What are the regulators going to do? What are the political leaders going to do? Not just here in the United States and in Asia, but also overseas in Europe as well.
Yeah, well, let's take a look at the stocks index here. You can see some of this price action confirming what you've been saying.
Yeah, so this is the bank index for the largest banks in Europe, and this is a monthly chart, so it goes back, back to 1999. As you can see, the lows from 2009 come in pretty close to the lows that we saw in 2012, which was their secular lows, again in 2016. And with this month, we're now seeing a breakdown below the 2009 lows, and we're testing those lows this week that were initially made in 12 and in 16. I think the concern is, the interest rate environment in Europe. It's, while we were raising rates the last couple of years, the Fed hiked rates 9 times and they're doing quantitative tightening. Europe hasn't been doing that at all. The German 10-year bond today hit negative 70 basis points. So, and that's the case all throughout of Europe. So they have inverted yield curves. They have negative interest rates, not good for the banks. And I think it's a problem. It's a concern. We just had Angela Merkel speaking on Tuesday night. And people were expecting, people were hoping for a fiscal response, not just the same old actions from the monetary policy side by the ECB. And we have Christine Lagarde calling for additional fiscal measures. Even Mario Draghi has been mentioning it as well. And Angela Merkel, leader of Germany, is saying not just yet. So I'm not sure what they're waiting for. We just saw some negative GDP numbers for Q2 out of Germany yesterday. It was modestly negative, minus 0.1%. But you think they'd want to get out ahead of this. So it certainly looks like there's a lot of reasons to be cautious right now.
How much more can they cut is the first question. Second of all, even if we were to get a rate cut in the U.S., what is that really going to do relative to the global backdrop? We have a very uncertain trade policy. Global economies are slowing for sure. People are putting so much money into bonds that you have these negative yields. They don't even want to put them into equities. I don't think rate cuts are going to necessarily evaporate what's out there.
Right. So in Europe, I would agree with that. I don't think rate cuts are the answer. I think at this point we do need a fiscal response to get some stimulus going, some economic activity going. Here in the United States, I do think a rate cut would be appropriate, or deeper rate cuts would be appropriate, because relative to what's going on around the rest of the world, our yields are still pretty high. If you look at the overnight rate here in the United States, it's still well above our 10-year rate, which today dipped below 1.5%, and it's well above many other 10 and 30-year maturities overseas in Europe and in Asia. So relative to the rest of the world, we're extremely high. That's why our curve is inverted on the short end as well, despite the fact that we are seeing relatively good economic numbers up until now. Now, GDP numbers that have been strong is a lagging indicator. So other numbers like ISM and PMIs here in the U.S. have been coming down quite dramatically. So, and that's been the problem overseas, the manufacturing in particular. So I think it's something that we should try and get out in front of, try and at least flatten, if not attempt to actually steepen the yield curve. If we do these 25 drips of 25 basis point cuts, we keep dripping that out over the next 3, 4, 5 meetings, it might be too slow of a response, particularly if we're going to see economies like in Germany be slow with their fiscal response, if at all.
It sounds like best house on a bad block scenario.
Correct.
Right.
Good analogy, yeah.
All right, Brian, as always, thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.